At 10 a.m., in London, something unusual was happening. Phones were ringing non-stop. Traders were shouting numbers. Screens were flashing red and green. Billions of pounds were moving in seconds. But in the middle of all this noise, one man was sitting quietly, watching, waiting. His name was George Soros. And on this day, he was about to make one of the most dangerous and famous bets in financial history. This was not a bet on a company failing. Not a bet on stocks going down. This was a bet against the British pound itself. Against the money of an entire country. To understand how this became possible, we need to go back a few years to a time when Europe believed it had found a perfect solution. In the late 1980s and early 1990s, European countries wanted stability. Currency prices were moving up and down too much. This made trade difficult. Businesses didn't know how much they would earn. Governments wanted control, so they created a system called the exchange rate mechanism. Known as the ERM, the idea was simple. Each country agreed to keep its currency within a fixed range. If the currency moved to high or to low, the government and central bank had to step in. They would buy or sell their own currency to keep it stable. On paper, this looked smart. Calm markets. Predictable trade. Strong cooperation. But there was a hidden problem. Not all economies are the same. Some countries were strong. Others were weak. But the ERM treated them as equals. It forced weak economies to act strong, and that is where trouble begins. Britain joined the ERM in 1990. At first, it sounded like a good decision, politically. It made Britain look powerful and serious in Europe, but economically, Britain was already in pain. Inflation was high, growth was slowing, businesses were struggling, people were losing jobs. The economy needed lower interest rates to breathe, but the ERM did not allow that. To keep the pound strong and within the fixed range, Britain had to keep interest rates high. High interest rates make borrowing expensive. Loans cost more. Businesses invest less. Families suffer. It was like pressing the brake while the engine was already weak. George Soros noticed this contradiction. He looked at Britain's economy and asked a simple question. Why is a weak economy pretending to be strong? Soros believed markets eventually expose lies. Governments can delay reality, but they cannot erase it. The pound, in his view, was priced higher than it deserved. And the longer Britain tried to defend it, the bigger the eventual collapse would be. This was not a guess. Soros studied Britain's actions carefully. He saw that the government was spending huge amounts of money to defend the pound. Every time it dropped, the Bank of England stepped in and bought more pounds to push the price back up. This worked for a short time, but it came at a cost. That cost was billions. Soros understood something very important. A government does not have unlimited money. Every offense weakens the defender. While politicians were talking about stability and confidence, Soros saw fear behind their decisions. He saw leaders trapped by their own promises. Leaving the ERM would look like failure. Staying in it was slowly destroying the economy. Britain was stuck. This is where Soros made his move. He decided to sell the British pound in massive amounts. But he did not own that much pound, so he borrowed it. He borrowed billions of pounds and sold them immediately. His plan was simple but extremely risky. If the pound collapsed, he would buy it back later at a lower price, return what he borrowed, and keep the difference as profit. If he was wrong, he would lose billions. This was not a normal trade. This was a direct challenge to the British government. At first, no one noticed. The pound moved slightly. The government defended it. Everything looked normal. But underneath, pressure was building. Soros was not alone for long. Other traders began to see the same weakness. They saw Britain burning money to defend an unrealistic price. Selling increased. The pound started to slide more often. Each defense became more expensive. Each intervention sent a message to the market. This currency needs protection. And that is the worst signal a government can send. Soros watched calmly. He did not rush. He waited for confirmation. And when Britain raised interest rates again to defend the pound, Soros knew he was right. This was not control. This was desperation. The stage was set. Britain was running out of money. The market was gaining confidence. And one man was ready for the final move. Early on the morning of September 16, 1992, the British government already knew it was in trouble. The pound had been under pressure for weeks, but this morning was different. Selling was heavy, very heavy. Markets around the world were awake, alert, and ready. Everyone was watching Britain. The question was simple: would the government hold the line, or finally give up? As trading began in London, the pound started falling again, not slowly, not quietly. It was being pushed down by huge orders from traders who believed the same thing George Soros believed, that Britain could not keep defending an unrealistic price. The Bank of England reacted immediately. They entered the market and began buying pounds in massive amounts. Billions were spent in a matter of hours. The goal was to create confidence, to show strength, to tell the market, we are in control. But the market did not believe it. Every pound the government bought was sold again almost instantly. It was like trying to stop a flood with bare hands. The more the government pushed, the stronger the pressure became. Inside government buildings, panic began to rise. Phone calls were made, emergency meetings were held. Officials watched screens as the pound continued to slide. The cost of defense was exploding, and still, the market kept selling. George Soros was watching all of this closely. When he saw the size of the government's intervention, his confidence grew. This was not a normal defense. This was a desperate one. Soros made his decision. He increased his bet. He borrowed and sold even more pounds. His total position now reached over $10 billion. This was no longer just a trade. It was a full-scale attack. By mid-morning, the government made a dramatic move. They announced that interest rates would rise from 10% to 12% immediately. This was meant to shock the market. Higher rates meant higher returns for investors. The government hoped this would stop the selling. For a brief moment, it worked. The pound paused. Selling slowed. Some believed the government might win, but the pause didn't last. Traders understood the reality. Britain's economy was already weak. Higher interest rates would make things worse, not better. Businesses would suffer. Jobs would be lost. This was not a solution. It was a warning sign. Selling returned, stronger than before. The government was now under extreme pressure. Then came the most desperate move of all. Interest rates were raised again, this time to 15%. This was an emergency action, a message to the world that Britain was fighting for survival inside the system. But instead of showing strength, it revealed fear. The market reacted immediately. Selling exploded. The pound dropped faster. Losses grew by the minute. The cost of defending the currency became impossible to ignore. Britain was spending billions, and it was not working. Inside the government, reality finally hit. There was no more room to fight. No more money to burn. No more confidence to protect. Staying in the system meant endless losses. Leaving it meant public failure. By the afternoon, the decision was made. The British government announced that it would leave the exchange rate mechanism. The defense was over. The pound was no longer protected. As soon as the announcement was made, the pound fell sharply. What the market had been waiting for finally happened. The price dropped to where it truly belonged. George Soros moved quickly. He bought back the pounds he had sold earlier, now at much lower prices. He returned the borrowed money, and the difference became his profit. By the end of the day, Soros had made around $1 billion. Britain had lost billions. Black Wednesday was over. But the damage was only beginning. When Black Wednesday ended, the markets moved on. Traders closed their positions. News headlines changed. But for Britain, the real impact was only beginning. The British government had lost billions of pounds in a single day. This was not abstract money. It was public money, taxpayer money, funds that could have been used for hospitals, schools, and jobs. Instead, it vanished trying to defend a currency price that the market never believed in. For ordinary people, the event felt confusing. Most citizens did not wake up that morning knowing their country's money was under attack. They went to work, they watched the news later. And suddenly, they were told that Britain had failed to defend its currency. Confidence disappeared almost overnight. The government tried to explain. They said leaving the system was necessary. They said it was a strategic decision. But the public saw it differently. They saw chaos. They saw panic. And they saw leaders who had promised control but lost it in one day. Trust was broken. Black Wednesday followed the ruling government for years. Every election, every debate, this day came back. It became a symbol of poor judgment and economic failure. Many experts believe it played a major role in the government eventually losing power. George Soros, meanwhile, became famous around the world. The media gave him a dramatic title, the man who broke the Bank of England. Some praised him as a genius. Others blamed him for Britain's pain, but legally and economically, Soros had done nothing wrong. He played by the rules, he made a bet, and he won. But the deeper lesson was not about Soros, it was about power. For decades, people believed governments controlled markets. Black Wednesday showed the opposite. It showed that when policies are weak, markets will test them. And if the defense fails, markets will win. Inside Britain, something unexpected happened next. After leaving the ERM, Britain regained control of its interest rates. The government was finally able to lower them. This helped businesses borrow again. Investment slowly returned. Over time, the economy began to recover. Ironically, the very thing Britain was trying to avoid, leaving the system, ended up helping it. But the cost of learning this lesson was massive. Black Wednesday became a warning to the world. Central banks and governments everywhere studied it closely. They learned that defending a false price is dangerous, that confidence cannot be forced, and that once the market smells weakness, it does not forget. This single day changed how currencies were managed forever. To understand why George Soros succeeded, we must understand how he thought, not just what he did. Soros did not see markets as machines. He saw them as reflections of human behavior, fear, pride, denial, and hope. He believed that people in power often make bad decisions because admitting mistakes is painful. And when leaders refuse to accept reality, markets eventually force them to. This idea was at the center of everything Soros believed. In Britain's case, the mistake was clear. The government had locked itself into a system that did not fit its economy. Inflation was high, growth was weak, jobs were at risk. The logical move was to lower interest rates, but the ERM did not allow that. Instead of fixing the real problem, the government chose to protect its image. Leaving the system would look like failure. Staying inside it meant pain. So they chose pain and hoped it would go unnoticed. Soros understood this psychology very well. He knew governments often delay bad news as long as possible, and delay creates opportunity. Soros asked himself a critical question: what happens if everyone realizes this policy cannot work? The answer was simple. Selling would increase, pressure would grow. The cost of defense would rise, and eventually, the government would be forced to quit. This is what made Soros different from other traders. Many saw the problem. Few were willing to act on it at such a massive scale. Soros did not just believe the pound was weak. He believed the government's behavior made collapse inevitable. Another key part of Soros' thinking was risk control. Even though the bet was huge, it was carefully planned. Soros watched government signals closely. Every interest rate hike confirmed his view. Every public statement promising defense made the position stronger. These were not signs of confidence. They were signs of fear. When most people see fear, they panic. When Soros saw fear, he became calmer. He understood that markets move slowly until they don't. Pressure builds quietly. Then suddenly, everything breaks at once. Black Wednesday was not random. It was the final moment of a long build-up. Soros also understood a harsh truth. No government has endless money. They can print, they can borrow, but defending a currency at the wrong price burns reserves fast. Once reserves run low, confidence collapses instantly. Soros knew that if Britain reached this point, the fall would be violent. And that is exactly what happened. This is why Soros increased his position instead of reducing it. The facts did not change. They became clearer. Every hour the government defended the pound, it proved his theory correct. Black Wednesday later became a famous lesson taught in finance and economics. Not as a story of attack, but as a story of misaligned policy. When political goals ignore economic reality, markets respond without mercy. Black Wednesday did not end in 1992. Its lessons are still alive. What happened between George Soros and the British government was not a special event that can never happen again. It was a clear example of what always happens when reality is ignored for too long. Markets can be delayed, controlled, and guided, but they cannot be fooled forever. Britain tried to defend a price that did not match its economy. The market tested that defense. The defense failed. And when it failed fast. This is the most important lesson of the entire story. Governments often believe that power, rules, and authority can protect them from economic truth. But markets do not listen to speeches, they react to numbers. Growth, inflation, debt, and confidence. When these do not match policy, pressure builds quietly in the background. Then one day, everything breaks. George Soros did not create this break. He did not control the market alone. He simply understood when the system had reached its limit. Many others joined the trade only after the weakness became obvious. This is why Soros is remembered, not because he was powerful, but because he was early. After Black Wednesday, central banks around the world changed how they think. Fixed currency systems became less popular. Governments became more careful about defending unrealistic prices. Flexibility became more important than pride. Britain, in the long run, recovered. Once free from the system, interest rates were lowered. Businesses slowly returned. Growth improved. Many experts later admitted that leaving the ERM was necessary, but the delay made it costly and humiliating. The deeper message is uncomfortable. Markets are stronger than politicians. Truth is stronger than promises. And denial is the most expensive policy of all. Even today, we see similar patterns. Governments defending currencies, fixing prices, ignoring warning signs. Every time this happens, history reminds us of Black Wednesday. One man saw the truth early, a nation accepted it too late. And that single day became a permanent warning written into financial history. This is why the story of George Soros and the British pound still matters, not as a tale of victory or defeat, but as a lesson about reality, power, and the cost of ignoring the truth.